we are going to say what are the various kinds of interest rate derivatives, and there are many, but we are going to just focus on a couple of them only, because the course says that we have to do only interest rate swaps. Okay, we're going to talk about interest rate derivatives are financial instrument whose value is derived from movement in interest rates, because it's the interest rate which can affect the value of the derivatives. They are widely used by financial institutions, corporations, and investors to manage interest rate risk or speculate on future interest rate movements. Okay. So hedging interest rates risk. Traditional methods. These methods can further be classified into following category: asset and liability management. So you manage your asset and liability. Usually all the financial institutions or companies or bank, they manage their asset and liability because they have liabilities in terms of servicing the fixed deposits, saving accounts. That's the liability of the bank. And the assets are the loans given as housing loans, corporate loans. So they have assets which generate interest revenue, and their liabilities which involve payment to cash outflow from the company. So both should be properly managed, because they have, there is a mismatch in the durations, because the loans are given for 10, 20, 30 years, whereas the deposits are there only for 1 year, 2 years, 3 years, and interest rate keep fluctuation. It can cause an impact on their profitability. Okay. So asset and liability management. So we're going to talk about that. Then there is a forward rate agreement. Okay, where my slide contains the material on that, so you can just go through. I'm going to skip that. What we are going to understand is interest rate futures, interest rate options, and interest rate swaps. Okay, so the more modern methods we are going to talk about, which are affecting most of the companies. Asset liability management only concerned with the banks. Okay, FRAs anybody can take, even corporates can take. So financial institutions ensure its loan portfolio is balanced between fixed rate and variable rate products. That means they give loans both in terms of fixed interest rate as well as variable. So when they give loans at both, so even if the interest rate goes up and down, they are not going to be so much impacted if they're given the loan on variable. So that means if the interest rate goes up, they're going to get more interest from the person who has borrowed the money from them. Okay, because some borrowers, they always prefer a fixed rate, so they just keep the interest rate a little higher so that they don't lose out. I was telling you that I took a loan way back in 2006 when the interest rate was the lowest. I got it at 6%. Okay, for 15 years, just closed down last year only. I just finished, repaying that loan. So for the 15 years long, I paid just 6% loan, 6% rate of interest, fixed rate. Whereas floating rate was available at say 5.5% that time. But I choose to pay more, 0.5%, because though I was not that much, I didn't have idea that the interest rates are going to, go up. But some kind of a thing came in mind that I should pay more and let it be, say, 6%. And it happened like this: the interest rate on housing loan went up as high as 11%. And I was still paying 6%. Most of the people who borrowed along with me, there were about 15 people who borrowed in the company. They were paying 11, 12%. Then they all called me up and said, you did a great job that you are just paying 11%. I also checked with the Standard Chartered whether they are charging 6%. They said your loan is for full 15 years, it is 6%. It's not going to change, because that is a term you have agreed with the bank. Even if the interest rate goes to 20%, I'm going to pay at 6%. So I continuously paid at 6%. And thereafter, the banks realized that this can cause problem, because if the interest rate goes up and their fixed deposit cost goes up, and the interest they're paying only getting only 6%, that will adversely impact their profitability. Now what they do is, anybody who comes asks for a fixed rate of interest, they say, okay, we'll give you higher, plus after every 3 years it will be again reset. After every 3 years, it is reset. It's never given for 15 years long for a same kind of interest. So now they become wiser. So they are giving fixed only, which is reset after every 3 years. So that only you can enjoy up to 3 years at the most. Okay. So if you look at the balance sheet of a bank, it looks like this. So just focus on deposits. How much deposits they have? 26 lakh 40,000 crores. This is State Bank of India. And look at the liability side of the bank. So first is capital, then reserve and surpluses, then minority interest, then deposits, and then borrowings. So this is the money which the bank has generated. This is their liabilities. That means the bank has have deposits, saving accounts, but not for 26 lakh 40,000 crores. And then it been rising from 2016. It was 23 lakh 92,000, and then they borrow also money. Okay, because they need more money to lend, so either they get it from the depositors or they get it in form of borrowings from the various institutions or abroad. So how much is the total borrowing? If you look at deposit and borrowing, it's about 29 lakh crores. And look at now the loans. The loans are given on the bottom with the assets of the company, so which is net advances. So 18 lakh crores plus the investments. So either the money which has been collected in form of deposits or borrowings, they are deploying it back into the business and earning interest on that. Their main job is to give loans. So that is around 18 crores, but they can't lend all the money as per the RBI norms and Basel norms prevailing in the international. So the bank's balance sheet has to be healthier. So some money needs to be put in investments. So they have investments of 11 crores. So you look at both, they are almost like matching 29 crores of liabilities and 29 crores of assets. And some are in form of investments, and major investments are in form of government securities. So they have to put back the money in government GSECs. Okay, the government which paying around 7% depending on the interest rates, coupon rates which they are giving. So it is 11 crore 28 lakhs. So they need to manage these two in such a way that they are able to generate profits all the time. Okay, so this is called asset liability management, where I have written how they do that at the bottom here. You can go through what they do more in detail. Okay. So now we come to the forward rate agreement. I'm going to skip. You can just go through yourself. Maybe time permits, I'll just take you through. But first, we'll cover the course. So only what we are doing, the slide is very long, so you just focus on what I'm teaching. Rather, you can skip for the exam. So it is interest rate swaps, which is the major chapter, which you might have done in your some course, isn't it? Correct? Huh? IFM. Okay. So I'm just going to give a different perspective to it a little bit because every person has a different way of teaching. So I'm just going to tell you that. An interest rate swap is a contract between two parties to exchange one stream of interest payments for another, typically to manage exposure to interest rate fluctuations. Okay. So interest rate swap is a contract between two parties to exchange one stream of interest payments for another, typically to manage exposure of interest rate fluctuations. Okay, so you're going to manage your interest rate exposure, so you're going to enter into an interest rate swap agreements. Okay, type. So now just focus. So there are two kinds of interest rate swaps. Maybe the first one you have done, second you might have not done. Just let me know if you are not done or not. Okay, so I have questions for both. So if you're comfortable, I can give you the second part, which you have not read earlier. So it'll be, it's also very simple. Okay.
So we have done interest rate swap, but we haven't done interest rate futures and options.
फ्यूचर एंड ऑप्शंस.
The interest
हाँ,
rate one we have
वो
done that.
इसलिए वो इस कोर्स में भी कोर्स आउटलाइन में नहीं है, which is designed by the, but I'll just take you through that little bit.
Well, this you can skip probably and give more.
But क्वेश्चन इसी में सेट हो चुका है मेरा. ओके, और कोर्स में यही है, और मैं आपको फ्यूचर्स में भी ले जाऊंगा. Okay, so don't worry about that. I'll just take you to the futures. Okay, so don't worry. So fixed or because this is part of your course outline, so I can't skip that. Okay, fine. Last time मैंने नहीं पढ़ाया था, तो there was a lot of objections from the students, and when they gave the feedback, they said ये तो पढ़ाया ही नहीं. So I don't want to miss that. Okay. So fixed or floating. Now the second part which I'm going to tell you is might have not done so far. Tell me that. Fixed or floating swap. One party pays a fixed rate and other party pays a floating rate. Okay. Now floating rate today, what is prevalent is called SONIA, SOFR, or other this thing. Okay. So I'm going to talk about SONIA and how it was developed and what it has replaced. What it has replaced? SONIA को पहले क्या था? LIBOR, London Interbank Offered Rate, or MIBOR, which is Mumbai Interbank Offered Rate, or TIBOR, which is Tokyo Interbank Offered Rate. Similarly, we have rates all over the world, and they were all this thing. So what is the problem with those LIBOR, TIBOR, MIBOR? Why it led to a change into a new format? Anybody? ऐसा क्यों हुआ था? पढ़ लिया तो बताओ. LIBOR क्यों खत्म हो गया? या क्यों फेज आउट हो रहा है? अभी इंडिया में अभी भी है. World over, it is getting out. Of course, there are some legacy instruments which are prevailing in the world, which are again on the LIBOR, and until over the passage of time, they will go out and phased out, and we will have the new system. LIBOR. And how was the LIBOR determined? First of all, LIBOR determined कैसे होता है? LIBOR कैसे पता चलता है कि what is the London interbank offered rate or Mumbai interbank offered rate or what so? How it is determined? How the rates are determined? How people come to know that LIBOR is 5% or 3% or 4%? Any idea? हाँ बिल्कुल सही बात है. देखो क्या है कि इसी में तो छुपी हुई है कहानी. बिकॉज देर इज like earlier it was British Banker Association, which is now the different bodies there. So they used to call up the banks in the morning around 10 o'clock or somewhere, okay, and ask banks how much rate of interest they are going to charge if somebody comes to take a loan from them, okay, and not individual how much rate of interest they are going to charge if another bank comes to you for taking a loan from you. Not individuals, only the banks, because banks lend to each other. It's an interbank rate. A LIBOR was an interbank offered rate. So how much one bank would charge to another bank? Suppose the State Bank of India wants money and they approach ICICI Bank. So they'll say, we need money for just 5 days. What is the rate of interest we are going to charge? Okay. So these companies in England, they would, British Bankers of Association uh, uh, of England, they would call up all the banks in the morning and check with them, if somebody approaches to you, other bank, what is the rate of interest the bank is going to charge? Now they will ask a couple of questions. If somebody approaches for 1 month, 2 months, 3 months, like this, okay, some different period, because somebody can need money for a month, somebody bank needs for 2 months, somebody so they will give three kinds of rates. Okay, this is a short-term lending rate. Okay, up to 1 year. So banks will give their quotes, and the BBA will take those quotes, exclude the outliers, okay, and make an average of that. Suppose that average comes to 5%. Suppose the 1 month LIBOR. So they'll say that 5% is rate of interest for 1 month. So that is the cost of the bank. Now suppose a bank in England has to borrow at 5%. Now if a customer comes to the bank and say, I need money, so they'll say LIBOR plus 2% or LIBOR plus 1%. So that 1 or 2% will be their earnings, okay, or the bank when they lend the money to an outsider. So if they are getting LIBOR as their cost, so LIBOR is a cost or an opportunity cost. If the bank doesn't require any borrowing from other, but still that is a cost which is considered for calculating for the bank, that this is the current cost of taking money from another bank, plus I'm going to charge 2%, 1%, 3%, depending on the borrower. Like Reliance would go and say, we need money. The LIBOR plus 3%. He says, no, I'm going to pay just LIBOR plus 0.5%. Because the companies like Reliance will borrow in millions and billions. So they can always influence the spread. Okay. It depends upon who is borrowing, what is his muscle power. The spread may come down depending upon the borrower's strength with the bank and the negotiation with the bank. So now all this was done through a poll in the morning. And this was subject to a lot of manipulation. Though it's continued for a long, but then there were some scandals which broke out. So then the banks decided, or the Federal Bank or Bank of England or Reserve Bank of India, they decided that we need to phase out this mechanism. We can't rely on that so much. Okay. Earlier they were relying on that. They found that this is subject to a lot of manipulation. So then they said, what should we do? The question was, how do we move on to a new system? So the banks in India, for example, let me tell you, they when the bank needs money from another bank, okay, so the bank would approach either RBI or another bank for taking money for 1 day, 3 days, because all the banks need to maintain a reserve ratio, CRR, all those ratios they have to maintain, liquidity ratio, whatever ratios they have to maintain. So bank needs to park some money in G6. On every Friday, they have to make sure that they have certain amount of money which is actually invested into government bonds. If it falls short, because they can't lend all the money which they have got from deposits, so they have to maintain a sanity. So they will bring down their deposit to loan ratios in such a manner so that they have parked some money in various kinds of G6. So when they have to invest in G6 and they don't have money, they have to borrow. So maybe for 1 day they need to borrow for a Friday, and then again they be back to normal business till the next Friday they borrow again for 1 day, or sometimes they borrowed for long. So they will approach another bank or RBI for taking the help of to get money so that they can park the money in the G6 or whatever it may be they require. It's not only the G6, but sometimes the requirement maybe for lending money also. So the bank, RBI, and now there was, before the repo system came in India, so banks were giving at whatever rate they felt like. Suppose the State Bank of India asked the money from, say, ICICI Bank. So ICICI said 18%. Now it's a huge amount. At the time there was a credit squeeze and the global financial meltdown, the interest rates were rising in the world, and the interest rates were becoming very difficult, and it was affecting the balance sheet of the bank. So the banks decided, of course, they decided much back before even the financial crisis happened, that Reserve Bank said that we are going to announce a repo rate, okay, and that rate will remain the same till we announce another one. So it's a repo rate. So today the bank repo rate is 6.5%. It's a short-term lending rate of RBI. So RBI say if any other bank comes to us, we will charge you 6.5%. Now all the banks can go to the RBI, but when they approach even SBI can't charge more than 6.5% because the market rate is 6.5%. So they have to borrow at 6.5%. Chalo, we will talk about the margin. I'm just giving a concept here, just understand that. Now the bank is, I'm going to take you to an example also so that you understand what question you're asking. So the banks, I'll just show you here, first of all, how the, first of all, high, so because the MIBOR is still in existence in India, it has not been phased out. So I told you this is the method, how the MIBOR is determined. So banks submit their offer rates. So it starts from here. What is MIBOR? It is Mumbai Interbank Offered Rate. It's the interest rate at which the banks in Indian interbank market offer to lend unsecured funds to one another for short durations. Now, mind you, there's one word is unsecured. It's an unsecured loan. Okay, so it serves as a benchmark rate for various financial institutions in India, such as loans, derivatives, and debt instruments. It is similar to the concept of LIBOR, but especially for Indian rupee. So in India, the MIBOR is still prevalent. It has not been phased out. It's in about to be phased out. The new system is already brought by the RBI, but it's under scrutiny, in discussion with various banks. Once the bank and RBI decides, maybe it will get rolled out from next month or maybe next to next month. So who administer in India? Like BBA is administrating in England. Of course, BBA is now gone. There's another body which come. Uh, the rate is published by Financial Benchmark FIBL. Okay, there's an organization called FIBL which manages this. Now, MIBOR is typically determined for a tenor such as overnight, 14 days, or 1 month. So they will ask this question. There's a polling method like the BBA was doing, then the calculation and publishing. So that means first it is the polling is done, then they calculate, and then they publish it. Okay. So banks submit their offered rates for unsecured borrowing in interbank market. Only certain authorized banks participate in this process. The rate is calculated as weighted average of the lending rate submitted by these banks after removing the outliers. Okay. The calculation excludes the extreme rates. Publishing, the rate is published by FIBL now. Earlier, the National Stock Exchange was publishing. Now, the FIBL has taken over the job. So, they'll do the poll. They'll get the rates from various banks. Okay. And then they have got from the bank A, B, C to Z. And then they will remove the outliers. Okay. So, they'll remove the highest and the lowest. And the remaining rates are going to be averaged. And they calculate the weighted average of that. And then they find that the MIBOR is 5.23. Then the rate is published. Okay. And this becomes the rate for which is now under scrutiny, that should we continue this rate or it has been phased out now world over. Now the other rates have gone up. This thing is MIBOR still being used? Yes, MIBOR is still being used, particularly for domestic financial institutions such as all these. Then is MIBOR still being used? Yes. Now the RBI is now replacing that with a new one. So this is still in the under process. So now we come to a question here. So what is so interest rate futures you're talking about? So this is there in my slide. Right at the end, I think. So MIBOR alternate, which is under work now, RBI is still thinking about that. They have made actually a paper which is being, you know, Okay. So I'm just telling about the now understanding the repo rate in India. Is this what I'm looking for? Huh. Yeah. So understanding the repo. This is very important. So please focus. Understanding the repo in India. A repo transaction. Harsh, can you read?
A repo transaction in India is a tool for short-term borrowing where a bank sells loan securities at variable rates for government bonds. Other party, RBI as a bank or financial institution, with an agreement to repurchase them at a higher price on a future date.
So what happens is now if the bank needs money, bank needs money to comply with the RBI requirement. So it is short of some money, say 100 crores, 200 crores. The bank will approach to either RBI or to any other bank, ask for some money. So what they do is it's called repo instruments, repurchase agreements. So it says that I want to borrow money. What is the rate of interest you are going to charge? Bank A asks another bank B. So the bank says 7.5%, but the repo rate is 6.5%. So that is the clean credit. Okay, fine. Even RBI has announced the clean credit, which is around say 7.5%. अगर आपने अपने इंस्ट्रूमेंट गिरवी नहीं रखवाने हैं, तो rate is 7.5%. If you want money, if you can keep the government security as collateral, then the rate will be 6.5%. So 6.5% is repo rate. Okay, which means what? That the bank is going to first sell its G-Secs, which is holding. There are a lot of investments with them, which are in form of government securities. They say all the 100 crores worth of G-Secs I'm going to give you, but I'm going to buy it from you after one day. Okay, एक दिन के लिए आपको दूंगा, फिर खरीद लूंगा. That's called the repurchase. So they're going to sell the treasury bills of the government of India to another party, okay, with an agreement to repurchase them at a higher price in future. So whatever is the tenor of the loan, they are going to sell and buy back. The repo rate in India is determined by Reserve Bank of India and serves as a benchmark interest rate for short-term borrowing. Now, the Reserve Bank of India, to maintain calmness in the market, they have announced this rate so that nobody can charge more, nobody can charge less. Okay. So assume the following: the State Bank of India (SBI), lending institutions RBI. Now they have approached to RBI. They've not gone to another bank. So there is a liquidity adjustment facility of RBI under which they give money to the other banks. So securities sold, Government of India bonds. So what State Bank of India is going to do is they are going to hand over the securities to RBI for taking that loan. Value of the bond sold, 10 crores. So for example, State Bank of India needs 10 crores money for one day or for 14 days, whatever. So they are going to sell 10 crores. Repo rate 6.5%. Repo period is one day. So that means they need only for one day. In this example, they require 10 crores for only one day. So how it will work out? Repo rate into sale price into repo rate into days upon 365. So 10 crores at 6.5% for one day comes to 17,808 this thing rupees. Okay, 17,808 रुपया ब्याज लगेगा एक दिन का for one day for 10 crores. So this we have calculated at the repo rate. Determines the repurchase price. So the price is original sale price was 10 crores. They will buy at 10 crore. They will sell at 10 crores and buy at 10 crore 17,808. So this way, first they are going to sell the bonds at 10 crores, then they are going to buy back in the next day at 10 crores 17,808. So these are called the repurchase instruments. How that works? जितने दिन का है उतना ब्याज लग जाएगा और उसके हिसाब से आपने बेचा और फिर खरीदा, बेचा और प्रिंसिपल पे खरीदा along with interest. So this is how it happens and the bank gets money. Okay.
Repo is always accompanied by a government bond.
हाँ जी.
तो जब रेपो का कोई एलिमेंट करते हैं तो ये गवर्नमेंट सिक्योरिटी देना जरूरी है इसमें.
हाँ, देना जरूरी है. हाँ, रेपो के लिए.
तो वो जब सिक्योरिटी बाय बाय करेंगे तो उसमें इंटरेस्ट ऐड करके
देंगे. आपने पहले सिक्योरिटी बेची फिर खरीद ली और जितने दिन की खरीदी है वो 6.5% जो करंट रेपो है उसके हिसाब से वर्कआउट हो जाएगी, आप खरीद सकते हो. वो इसी रेट के हिसाब से आपका रीपरचेज का रेट आ जाएगा उतने नंबर ऑफ डेज के. ओके, नाउ जस्ट लेट मी जस्ट फिनिश एंड यू विल फाइंड मोर दिस थिंग. RBI, SBI sells 10 crores worth of government bonds to RBI. RBI transfer 10 crores to SBI. Okay. Closing after one day, SBI repurchases the bond from RBI at 10 crore 17,000. RBI earns 17,808 rupees. Is that okay? How the bank is making and how the bank is a cost for the State Bank of India and for RBI it's a revenue. Okay. Now There can be another thing that, sometimes because all the G-Secs, what happens is these values, they are quoted on the stock exchange. They are quoted in the market. Okay. So G-Secs can change. Price of the G-Secs can go up and down. Okay. Because they are quoted on the exchange. So in a day's time, they can even be brought down a little bit. So when the RBI says, okay, you're giving me 10 crores, don't give me 10 crores, give me a little extra to take care of if there is any drop in the GSEC prices. So in this case, they are going to actually give them worth 10 crore, 20 lakhs, 40,000. So if they decide that the factor is going to be, haircut is going to be 0.98, then the RBI will say, we need 10 crore, 20 lakhs of GSECs worth for giving you money. But the interest will be charged on 10 crores. But this is additional amount to ensure safety in the transaction. This is just for safety purpose because the security prices can go up and down. Okay. Do you know that security prices go up and down? Just to explain. Suppose the GSEC is 100 rupees. Mostly the GSEC is 100 rupees. It carries a coupon rate. Suppose the coupon rate is 7%. Currently, the coupon rate is close to about 6.5 or 6.6 or 6.7. It keeps changing. Okay. So every Wednesday, the RBI issues these bonds, which will have a coupon rate. Okay. Now, how the coupon rate is determined, that's very important. So they are going to announce that today we are going to borrow 100 rupees and they are going to auction these G-Sets. They are going to auction. So people are going to put bids. All the financial institutions. Okay. Individuals can also participate, but the participation is restricted. We can also, invest through mutual funds. This G-Set. So the bank has issued a G-Sec at 7%. Suppose this G-Sec was issued in January 2024. For example, let me say, today this GSEC is trading at 6.5 yield. And because the yield has come down, so that means GSEC is, or I just give an example. Suppose this was, then today it is trading at say 105 and the G rate is 6.85. So this is called the yield. And this is the rate of the, so anybody who wants to buy 100 rupees bond, he has to purchase at 105 now because this is valued more. Because he when he pays 105, he gets only 6.85% return as against 7% originally announced by the RBI. Because he's paying 5 rupees premium. Okay. Not in the coupon rate, but the yield. Because coupon was with the original bond, but in this you're not buying the original bond, you're buying a second-hand bond. Reliance is not issuing fresh shares, you're buying Reliance shares in the market. So those shares are trading at 105. So it is giving you 6.85% yield. This is yield to maturity. That means you hold till maturity. The government is going to give you 100 rupees only. Okay. And they're going to give you 7% per annum. आपको 7% मिलेगा. क्यों? क्योंकि गवर्नमेंट का बॉन्ड आपने खरीदा था उसका 7% कूपन था. But since you have bought it at 105, the yield drops to 6.85 for you. If you calculate how much is the kind of return I am getting, now a person will have two options: either to buy a second-hand bond or go to the fresh auction rate. Now, fresh auction will be happening at this rate because there's the yield currently prevailing in the market. So RBI is going to issue, looking at the yield, this is the current interest rate in India. So we are going to issue fresh bonds at 6.85, isn't it? So a person who has invested 100 rupees a year back is having a 5 rupees extra income today he sells plus this 7. So he's earning 12% rate of interest for holding the bond for 1 year. Isn't it? जिस आदमी ने एक साल पहले खरीदा था उसने 100 रुपए खरीदा था, उसको पूरे साल में 7% तो मिलेगा कूपन रेट प्लस उसको ये 5 रुपए प्रीमियम मिल जाएगा और he sells the bond in the market. Okay, when you expect the interest rates to go down, invest in bonds because it will give you higher value and you can earn more than the stock market returns at times without taking any, any kind of risk. There is no risk in buying a government bond because you're going to get money. But if you hold this bond till maturity, then suppose the person who has bought, he holds the bond, even if the interest rate goes, suppose the interest rates go up, suppose the interest rate goes to 8%, for example. So the bond value will come to 90 bucks. Okay. So if you have to sell the bond now, which you bought 105, you're going to make a loss. So the chances that you don't sell, hold till maturity because you're going to get 100 rupees back from the bank rather than face this kind of a situation. Now banks hold a lot of these sets, and the valuation of these sets keeps changing. Okay, so they report a profit or loss on holding those G6. When the interest rates come down, the G6 goes up, and the balance sheet looks very healthy for the banks. When the G6, when the interest rate goes down or goes up, and the G6 falls, the balance sheet looks very bad because they're holding lots of money in form of G6. So G6 keeps changing. And there's a bank called Silver Valley Bank in the world which collapsed because of this. Okay, because they're holding almost 80% of the bond in form of G6 of England, America there. And the interest rates were cut by Federal Reserve, and the bond value came down, and they became half. And all the persons who are given the money to the Silver Valley, they approached the bank to collect their money back. And they could sell all the bonds at 50% and give the money back to them. And the bank collapsed in the process. Okay. Okay. So is that clear? So let's come back to interest rate derivatives. Okay. So there is first mechanism which is called one party pays a fixed, another party SONIA. SONIA is basically the new rate which is based on the actual transactions. Like in India, we have the repo transaction. They said, okay, we are not going to go by the hearsay or polling method. Whatever transaction which are occurring in the repo market, we are going to take that rate. And the rate which is there in England, it's called SONIA, which is basically a SONIA overnight index. Okay, so this is again a similar looking this thing mechanism of like repo rate in India. Okay, yeah. So I'm just going to do. So now the second is floating for floating swap. This you might have not done. ये करा? Floating for floating. अभी तो fixed for floating और floating fixed देगा. Floating for floating. Both the party exchange floating rate payment based on different benchmarks. So this we are going to today do a question, and if you find comfortable, then I'll put in your exam. Otherwise, I'm going to put us the previous one, which is easier one. Okay, fine. Or I'll give you a choice so that if you don't follow it, then you can just skip. Let's see. So first we talk about the thing which you have learned. Company A, just give me 5 minutes and then we are going to end for the break. Company A has a floating rate loan but wants predictable payments. Okay. Company A के पास floating rate है, but he wants to move on to the fixed rate because he knows that the interest rates are going to, go up. Okay, when they go up, he wants to move on to the fixed. And the company B has opposing this thing. He has a fixed, but he wants a floating because he expects the interest rate to go down. So both the parties have different outlook of the market. So they agreed to a swap deal, which you have already done. So interest rate swap. So example, I'm just going to take a little while from now. Just read this, Harsh.
IRS contracts, interest rate swaps. IRS contracts enter into with counterparties this payment to the other for an agreed period of time based on the principal. One party makes payments at a fixed rate of interest. Exchange, this party receives payments at a floating rate from the counterparty. Floating interest rates are variable and flat at a specific index such as.
So, SONIA is the rate which is prevailing now in England. Okay. So, the floating rate is determined now. Instead of LIBOR, we have SONIA there. Okay. Which is called SONIA overnight index average. Okay. Okay. So, yeah. Just read.
When both lands are in the same currency, total amount is typically not exchanged between counterparties, but used only for calculating.
So, this that notional amount is not changed. Only the interest rates are swapped. Yes. Next.
When the legs are in different currencies, the respective notional amounts are typically exchanged at the start and the end.
So when there is a cross currency swap, then the notional as well as the principal, I mean the amount, so principal as well as interest are changed. Okay. Now suppose there are two parties. Yeah, read this.
Parties involved. Party A currently has a loan with Sonia and wants to switch to a fixed rate. Party B currently has a fixed rate loan and wants to switch to Sonia.
Okay, so this was a kind of opposing this thing. So we are going to complete this example a little later. So, अच्छा शायद इसी में हो रहा है. Okay.
Party A has a loan with an interest rate Sonia set periodically.
Reset periodically. Now, what does it mean? That if you take a loan on Sonia, Sonia is going to change. Every day the new Sonia comes. Okay. But once the Sonia is decided with the bank, then they are going to reset on a quarterly basis. आपको जो नेक्स्ट रेट होगा चेंज होगा वो क्वार्टर के बाद होगा. Even it is a floating, but it will remain fixed. What was determined a day, I mean, when you took the loan, it will remain the fixed for next 3 months or next one, depending on the banking policy.
Party B has a fixed rate loan with an annual interest rate of 3.5.
So now it's like situation like this. A has a floating loan which is paying SONIA plus 0.2%, and B is paying fixed rate 3.5%. So this is the current scenario. So structuring interest rate. Yeah.
Structuring the interest rate swap. Notional principal decided on the notional principal value, which is the amount on which the interest payments are based. Let's say 50 swap. Swap period determine the length of the swap. For simplicity, let's say 5 years.
So basically, the two parties, they decide on what is the amount, notional amount they are going to enter into interest rate swap. They may have loans higher than the amount, but they can, if suppose a person says that I want to 50% I want to hedge. So he'll take with the 50% or 70%, 60%, whatever he can take. So they've decided 15 million is going to be the principal amount, notional principal amount, and they're going to, and the swap period is can be 5 years, 3 years, till the time they think that the interest rates are going to go up or go down according to the outlook. They are going to decide on the period of the swap. Okay.
Fixed rate for party A. Party A agrees to pay party B a fixed rate of 3.5% annually for the notional principal. Floating rate SONIA for party B. Party B agrees to pay party A the compounded daily SONIA rate plus a spread of 0.2%.
So they enter into a different this thing. So that means it will look like this. A was paying variable to the lenders. B was paying fixed. Now they enter into a swap deal where A pays a fixed of 3.5% to B and B pays SONIA to A. So that when A pays B to 3.5%, he can meet out his liability of 3 point this thing, and he is now paying SONIA. So now he is on variable rate and A is now on fixed rate. By this swap, what has happened? A has moved from floating to fixed, and B has moved from fixed to floating. Are you able to capture this? So now A is paying B 3.5%. So he is now on fixed, but he is getting SONIA plus 0.2, which he pays to the bank. So in the result that he is now fixed on SONIA plus fixed. Okay, fine. Is that okay? Depending upon the interest rate view, they will exchange that. And this is normally done with the help of a swap bank or a broker. But here I've just excluded that. Okay, for the purpose of just understanding. Party A achieves, just read this.
Party A achieves fixed rate interest rate, providing predictability. Party B manages the risk of interest rate fluctuation by moving from a fixed rate.
So both have moved to different interest rate, one from floating, another to fixed. Okay. Now, just the last slide and before the break. Now, this is the rate of various rates prevailing in the world now. SOFR, which is the base, which is the overnight rate in England. So that is a rate in America, and SONIA is in England. And then we have dollar STR, which is a euro short-term rate. Saron, which is a Swiss average rate. TONA, which is the Tokyo overnight average rate. CORA, which is the Canadian overnight repo rate. HONIA, which is the Hong Kong. So different rates for different, and they are all based on repo instrument. Taking money, like if you the United States, who is the administrator? The central bank there. Like we have RBI there, the federal bank there. So correct. This is based on the overnight treasury repurchase. On the actual transaction which are happening in USA, the rates are determined on that basis, rather than on the basis of taking a poll. Okay, but there is a lot of difference between these rates and the LIBOR. LIBOR is a forward-looking rate, whereas these are the rates which is happening on a day basis now. Okay. Suppose the person comes and say, I want a loan for next 3 years. So these rates have to be changed into future rates. Not, these are the rates which are applicable for lending today. Suppose I want to borrow money for the next 3 months. Now, these rates may not be applicable as such. So they need to be converted at a future rate. So there is a mechanism through which we can calculate them, their future rates. So we have SONIA. Yeah, these are announced, not announced, but they are the rates which are prevailing. You can check the repo rate in England. So that would be the rate which will be applicable for your transaction. They're daily basis quoted in the stock exchange, quoted in the markets. Okay. Yeah. And then I told you that these rates are basically for the actual transaction taking place. Okay. For that particular day, what happened last day. But actually, the rates which are LIBOR, which how much they are going to charge for a future loan of one. So the rate is the spot rate. This is the spot rate, and you want to calculate the spot rate into a future rate. So that is another mechanism which I'm not discussing at the moment. Okay, because the spot and future will be what? The future rate of these interest rates. Okay, so now we have a break, and after the break, we are going to talk about the second, this is mechanism which you have not done, and then we move on to the options, and then quiz. Is that okay? ठीक है 10:30 10:45.